This is Sovrun. Today, we're exploring the Commodity Volatility Skew, better known as the Smirk. It's the secret map of market fear. I'm Rob, founder of Sovrun and a systematic investor. Every strategy, every metric, every video on this channel is built on real data and a disciplined framework. At Sovrun, we don't trade on gut feelings. We automate risk management, execution, and exits. So the numbers make the decisions, not emotions. When stocks drop, we panic. But in commodities, the biggest fear isn't a crash, it's running out. This fear of spikes creates a lopsided pattern in option prices we call the Smirk. Think of it as a panic tax, like a hardware store hiking shovel prices before a blizzard. You're not worried about shovels getting cheaper, you're terrified of being trapped without one. In commodities, the premium is on the upside. We calculate skew by taking the upside fear minus the downside fear. If oil upside protection costs 42%, and downside is 34, we get a positive skew of 8%. That's a bet on a price explosion. Compare that to the S&P 500, which usually has a negative skew of 22%. In stocks, we fear the floor. In commodities like natural gas, which can hit 15% positive skew, we fear the ceiling. Take the 2022 nickel squeeze. Prices tripled in days, and the cost of upside protection was 5 times higher than a drop. High volatility here didn't mean a crash. It meant a massive supply shock was about to hit. The Smirk shows where smart money is placing its disaster bets. When call premiums rise, a crisis is often already brewing. The takeaway? Follow the premium to find the next supply shock. If you want to think about markets the way a systematic investor does, follow @The Systematic Investor on YouTube, TikTok, and Instagram, and @Sovrun Investor on X. Learn more at sovrun.io. This is Sovrun, and this is how we invest.